the credit worthiness of the customers, the credit limits which are extended, then the invoices are prepared, and um, by presenting the invoices, the amount of due from the customers are collect over due dates. Then follow up procedures to remind them to collect them, whatever is that is taken up, monitoring the credit system, and then sometimes to get the cash amount from the customers. There are promptly so that they can minimize on their cost of capital. They also offer discount facilities to the customers. So these are the aspects which we have discussed yesterday. Then there is a concept about what is the amount of cash discount which is offered to the customers. There is a formula which is given. Discount may also reduce the number of bad debts. And what is the amount of annual cost of the discount is given by a formula. We didn't work out any question as such. So in today's class, we will take it up. Continuing further. Okay. See, we have discussed yesterday that when credit sales are made, so credit sales will allow them to increase their sales. That is fine. But along with the increase in sales, there are many other things which are getting affected. That is, their cost of capital increases, the storage, cost of capital increases, the operating cycle period uh, increases in the length or the number of days of credit period extends. So the operating cycle increases. So these are issues. Then another major important thing is liquidity gets affected. When liquidity gets affected, then they have to find other sources of finance, raise finance from other sources, and then increase their cost of capital. So that is an issue here in case of credit sales. Of course, we see that there is increase in sales. There is a benefit in terms of sales are increasing. Yes, but that is affecting so many aspects. One important point what we need to understand is liquidity gets affected. They would not have the available cash balance. If the cash balance is not available, then in that case there is an impact in terms of the reputation gets affected, because the current liabilities are not paid on due date. Anywhere anything which is due is not met on due date. That's the thing, and they would not have cash to meet their day-to-day operations. So for that reason, once the company sells the goods on credit basis to the customer, so when the goods are sold to the customer, okay, then as against the credit sales, an invoice is received from the customer. Okay, so on the due date, whenever the at the end of the credit period, the due date arises, on the due date, where on presenting the invoice, the amount will be collected from the customer. But because of the liquidity which gets affected, the company has an alternative, that is, it approaches an invoice discounter. What is invoice discounter? So with this invoice, so as against the invoice, amounts are collected. So the invoice will be um, presented to a financing institute, wherein they can get the amount whatever is due from the customer from the invoice discounter. So the company pays the invoice discounter. No, the invoice is presented to the invoice discounter as against the invoice. The company borrows up to 80% of the value of the debt. So it is kind of a security which is presented. So if it has to raise the finances, generally it is not possible that finances can be raised as and when they like, or as and how much as they like. So the financial institutions also seek some security. So some collateral, some security is what they look into. These invoices act as that. So these invoices are presented to the invoice discounter, and the invoice discounter extends loan to the company. At least 80% of the total invoiced value is extended as debt amount to the company. So company now is able to borrow funds as against the invoices. So the credit transaction, whatever happened, so the invoice which is prepared for the credit transaction, that invoice is present to the invoice discounter. So a percentage of amount, usually up to 80% of the amount, is given as loan to the company. So company also can face its liquidity issues, whatever has arisen because of credit sales, because the operating cycle has lengthened. Um, and after that, then on the due date, the amount will be collected back from the customers. So at the end of the credit period, let's say for example, here in this example, it says that the company sells goods to customers payable in 30 days. So as at the end of 30 days, the company receives payment from the customers. So the company will settle that due amount, whatever it has taken, borrowed from the invoice discounter. So the company pays the invoice discounter the amount borrowed plus the interest amount. Okay, so whatever are the invoices are acting as collateral or security. So because because the invoice discounter understands that the company is entitled to receive some amounts, there are certain dues which have to be collected by the company as on a particular date at the end of 30 days period. So as against that, a percentage of amount is given to them as a loan, so they can meet the during these 30 days whatever are the requirements, cash requirements, those things can be met from the amount which is extended by the invoice discounter. So that is the concept here, invoice discounting. So 80%, up to 80% of the amount can be given as loan. And after collecting the amount from the customers, the loan amount is repaid with along with some prescribed interest rate. So whatever is the interest rate, along with that, the funds can be settled up. So based on this concept, there is one financial service called as factoring service. So it works on par with what explanation just now we have looked into. It is the same concept, the same logic. Here we see that the company sells goods on credit basis to the customers. Okay, so the transaction number one is same, but after that we see that there is a third party called as factor. Factor is a third external party, but this factor is in the business of providing funds to the company. So they are in a agreement with the company that as and when the sales are made to the customers and the invoice is received, that invoice will be sent to the factor, and against the invoice the factor will pay a percentage of amount. Here also usually it is about 80% of the amount will be paid by the factor to the company. So company will immediately meet their cash requirement. So credit sales are made, and these credit sales as against that the invoice whatever is there is sent to the factor. Factor is a third party. This factor pays the amount to the company. Fine. And on the due date, so whoever has the invoice, who presents the invoice to the customer is supposed to pay the amount to that person. So now on the due date, factor will present this invoice to the customer, uh, and customer will pay the amount to the factor. So on receiving the 100% amount from the customer, whatever is the balance amount. So let's say in the first go, 80% of it was paid. So the rest of the amount, the 20% of the amount will have to be remitted to the company. But after deducting whatever are their charges, that is some administration and debt collection charges, whatever are they, those things are deducted and the balance of it is remitted by the factor to the company. So factor is also taking up the responsibility of collecting. Under invoice discounting, here we see that it is the responsibility of the company to go and collect it from the customers. The invoice discounter is only a funds provider. There is no other responsibility of collecting it from the customer. Okay, the invoices, as against the invoice, the amount is extended as a loan to the company collects it from the customer and pays it back. That is under invoice discounting. But that's not the case in case of factoring. Factor has to he would approach the customer and collect it from the customer. Okay, so here it says that debt factoring, administration and debt collection only. um, why are we saying only is what we will look into after a while. Okay. Another concept of factor says that the same is the case, that is company sells the goods to the customers. So the invoice is received by the company sends the invoice to the factor again pays a percentage of amount to the company. Then on the due date, factor collects the amount from the customers, and after collecting the amount from the customers, the factor deducts the administration charges administration charges and also the finance charges. After deducting the administration cost and the cost of capital, also deducting that, the rest of that, the balance of the amount will be remitted by the factor to the company. So that is the concept. Now, how is the second one and the third one different? Is the second one, the factor deducts only the administration charges but not the cost of finance. The cost of capital is not deducted when the amount is remitted. So that will be handled separately. But here in this case, when the rest of the amount, let's say that in the first to go, if the factor has paid 80% of the invoice amount, the rest of the 20% will have to be paid after the factor collects the total due from the customers. So after collecting the due amounts from the customer, then from the balance, now since already 80% is paid, the remaining 20% is there with the factor. So from the 20%, the administration charges and also the cost of interest, cost of finance, that is with financing costs, they are deducted, and the rest of it only is remitted by the factor to the company. There is one important thing which is under factoring is, see, the responsibility is shifted to the factor. So factor is taking up that role of collecting from the customers. What if bad debts occur? That again is an important point which has to be looked into. What if bad debts occur? Who would bear that? So there are two different types of factoring. Remember that factoring with recourse, factoring without recourse. So with recourse is when there are bad debts. So on presenting the invoices, the factor gets to collect the amount from the customer, but not all of them would be paying. There is a possibility that some of the accounts may be uncollectible. So if there are uncollectible accounts, there is bad debts occurring. So when bad debts occur, who would bear the loss? So bad debt is a loss which is borne by the company. Usually we see that. But now the accounts receivable, the invoices of the accounts receivable are transferred to the factor. So will it be that the factor will bear the loss arising out of uh, these uncollectible accounts? So who would bear the loss is the question. So if they enter into an agreement, the company enters into an agreement with the factor stating that it is with recourse. With recourse, so the uncollectible amount also will be transferred to the company by the factor. Factor will transfer the responsibility, the liability to the company. So company will bear the loss and account for that as uncollectible. But if their agreement is without any recourse, that is there is no going back on that, even if there is a loss on account of uncollectibles is there, factor only will bear the loss. So with recourse, it can be transferred it back to the company. Without recourse, nothing can be done, factor only will have to bear the loss. But why do you think that factors enter into such agreements that there would be in without any recourse? Is there any specific reason why would anyone take it up? What attracts them to enter into such agreements? Am I audible? No response. Absolutely.
Yes, ma'am.
Okay. Okay.
Ma'am,
Yeah.
maybe the firm charges some amount from the company.
Huh. Yes, the charges would be high. The administration, debt collection, these charges would be high charged by the factor. So factor is collecting higher amount of charges and taking up that responsibility of bearing the loss. So that's the only reason. So if the factor is ready to take up the risk, he is also expecting a higher return from the company. So some charges whichever are levied by the factor to the company, they would be at a higher percentage. So that is the point here. What we need to remember. Now let's come to the next part of it is which is accounts payable. Till now we were discussing about accounts receivable. First we started looking at what is working capital. Okay. After under the working capital, we learned about the operating cycle. We learned about inventory, how to manage the inventory. Then accounts receivable. So now it is accounts payable because current assets minus the current liability. So liabilities is also current liabilities is also part of the working capital. Accounts payable. Payable because the transaction took place on account or on credit basis. So when material is purchased from the supplier on a credit basis, we have this as accounts payable. Okay. Um, the most common liability which is raised is trade payable. So mostly this is the credit facility which is used by many companies because it's easily available. Okay, a major part of it, or the I mean, almost all companies utilize this particular facility. So it is simple and convenient source of short-term finance because whenever the material has to be purchased and material is purchased on a continuous basis depending on the requirement of the material, so many times it is taken up, so it is a continuous process of acquiring material. So in that case the easy way to get the loan and I mean get the credit facility is the facility which is extended by the supplier. So from the supplier, they can get this form of credit, simple and convenient source of short-term finance. Okay, it is normally seen as free. Okay, but there are certain features associated with that. Free in the sense because credit period is extended by the supplier, so they utilize that. At the end of the credit period, the amount is returned back. So we do not see that there is any interest paid on that. So whenever credit facility is given to the customers or offered by the suppliers, there are no finance costs associated with that. So no interest is paid on that credit transaction. It is only a facility which is extended, which is utilized. So maybe 1 month, 45 days, 60 days, or something like that. Some a number of days of credit is extended. So that is utilized. Okay. Supplier may offer a discount for prompt payment. So it is not about the free part of it. There are other features. The first feature is supplier also the way the strategy to make the customers pay before the due date, a cash discount is given. So also the supplier also would give a cash discount. So when there is a cash discount given by the supplier to avail that benefit, so a cash discount is paying less amount than what is the total due amount. That is the cash discount. So to avail that cash discount, if they do not avail that cash discount, they're foregoing that cash discount, which may be not advisable. So to avail the cash discount, so even if there is a credit period, for example, if we say that if the credit period is, let's say, the 30 days credit period, they can be relaxed until 30 days. They need not pay the amount until 30 days. But because there is a discount facility given, maybe within 10 days if they have to pay, so they are foregoing that benefit. They are foregoing that benefit because foregoing the discount is also not advisable. So they are foregoing the benefit of not paying it after 30 days. They are rushing up in terms of making the payment within 10 days so that they can get the benefit of cash discount. So that is one important point what we have to remember. Okay, supplier may offer a discount for prompt payment. Um, then the next point is cost. Cost is quicker payment leads to lower payables balance, which leads to increased need for other funding. See, on the current liability side, we have accounts payable. So if the cash amount, whatever is available, if it is all pumped into the payment of the, or it is utilized for the payment of accounts payable, so cash balance reduces. When cash balance reduces, they will again find it difficult to meet their requirements, day-to-day requirement. So quicker payment leads to lower payables balance, which will leads to increased need for other funding. So then, because cash balance has reduced, they have to approach other sources. So other sources of finances, maybe a short-term loan, a medium-term loan, or a long-term loan. Something they have to look at other sources of finances. Okay, what is the benefit? As against all this, the benefit what they get is they can get a cash discount because they are paying within 10 days. They can avail a cash discount of whatever is the percentage which is announced by the supplier. So that's the benefit which we see if the payments are made before the due date. See, undue delays in payments can result. So this is the scenario. So now accounts payable is a credit facility provided by the supplier. So the business can be relaxed to that extent that their payments can be made at the end of that period. So they can utilize these available funds for investing into other purposes, other assets. But because the supplier comes out with a cash discount policy, to avail that cash discount policy, the benefit, they forego the benefit of paying it at a later date. So they utilize all their cash balances to make the payment to the supplier. So since they are making the payment to the supplier, they would be short on the cash availability. So since cash is not available, they again have to find sources of finances to raise the cash amount so that they can meet their day-to-day expenses. So that is the scenario. The benefit what they are getting is they get cash discount. That's the benefit what they get. Okay. Apart from that, what we need to look into is accounts payable is a short-term liability which has to be made in the short run. So this the prompt payments to accounts payable indicate their um, uh, credibility point of it and their credit worthiness. So if they if they make the payments on due date, so they are sending out a message that they can run the business in the short run as well as in the long run. So there is a trust factor which will be established. The suppliers will look at the company as someone who are prompt in making the payment. So in future also they come forward to extend loans. If they fail to make the payment on the due date, so that is again sending a negative message stating that they are unable to meet their payments. So if they are unable to meet their payments, that puts them into an apprehensive situation where the supplier will not be willing to trade with the company in future because they are not able to make the payments promptly. Okay, that affects the business. Overall business gets affected. So making the payment promptly, okay, um, can build up their reputation or it can affect their reputation. Fine. So undue delays in payment can result in suppliers refusing. So if the payments are not made, suppliers in future may not be willing to extend more credit. Okay, supplier refusing to supply in future, the business reputation gets affected. Loss of reputation and goodwill, then supplier increasing price in future. So henceforth, because they are not the trust part of it is gone, so maybe supplier can come forward and supplier will charge higher prices for the material because they do not no longer trust the company that they would make the payments promptly, so discourage them or to get some benefit out of the the supplier also can increase the price in future. Coming to the next one, cash management. In the order of liquidity, we see cash. We see cash is the first in order. Cash and cash equivalents are first in the order. So earlier in these last two classes, I have discussed that generally cash is not kept available in the business because cash in the form of cash does not give any return. So when it does not give any return, so instead of keeping it as cash amount, either cash in hand, that is in the cash box, or cash at bank, they generally invest these cash amounts in some way or the other, some form of investment. So they are invested into other types of assets. There is a return which can be earned when the amounts are invested into assets. So no matter how small, still they earn some return, small, big returns. So from the long-term fixed assets, a higher rate of profitability can be earned as compared to the short-term assets. Fine. Now that is fine to make the to increase their profitability. If cash is invested into assets, that is very fine. But just now we've discussed that payables, if the amount is not paid on due date, the reputation of the business gets affected. In future, the supplier may not be willing to trade with them, or they can be charged with a higher price of material. So we see that if the cash amount is not available, that can result in certain disadvantages. So the reputation in the first place it gets affected. It would not, the other stakeholders will not be willing to be associated with them for future transactions. They may not trust the company because they are not making the payment promptly. That payment failure is arising because funds are not available. Because funds are not available, they have to um, they may have to miss their credit due date. Fine. So no cash balance maintained is also adversely affecting the business. More amount of cash balance maintained, also cash just kept as cash balance, also it has an adverse effect that there is no profitability out of that. So if cash is not maintained, liquidity is getting affected. Cash is maintained, profitability is affected. So there is a situation where we see that cash is available, we see profitability is getting affected. No cash, then what is getting affected is liquidity is getting affected. So liquidity, they are unable to make the payment on due date. So the liquidity is getting affected. Okay. So here we need to understand what should be the strategy in terms of cash. How much cash balance should be maintained by the company is what we are now looking into. So the topic what we are going to touch upon today is how much cash should be maintained, or what is the strategy in terms of cash that has to be adopted, cash and funding strategies. So first let's look at what are the reasons for maintaining cash. So why is cash to be maintained in a business? That is the, we're going to look at what are the reasons for holding cash. The reasons for holding cash, we see the first motive is transactions motive, because cash is needed to take up transactions by the buying part of it, making payment to various stakeholders, employees, workers, landlord, then other operating expenses, rent, all those things have to be met. So for day-to-day transactions, cash is needed. So why is cash needed, or what is the reason for holding cash? The amount of cash just to maintain, as cash balance is not giving any return is already discussed. But now, if cash is not maintained, also liquidity is getting affected. So considering the liquidity part of it, first we need to assess what are the reasons why cash is needed. The reasons for holding cash is what first we have to look into. Why cash is needed is because they have to meet the day-to-day transactions. So with the transactions motive, cash balance has to be maintained to meet all the payments to various stakeholders. Cash balance is needed, so cash has to be maintained. Second one is precautionary motive. Precautionary motive, that is to take to see some unforeseen things which may happen, and they may be required to meet that with cash balance. So precautionary thing, they maintain so some amount of cash balance, so as a precautionary motive. Speculative motive is another one. So speculative motive is, so they speculate that some benefits can be derived. For example, sometimes we see that there are discount offers extended by the suppliers or various stakeholders, or if material is purchased on bulk, or if the payment is made immediately, some discounts can be availed. So these are these may be coming up. We see that festive season, we anticipate that there would be a sale. So now in this January month also there are sales coming up, which is Republic Day sale. So um, so when such things come up, and there are certain discount facilities which are offered, to avail those things. So some amount of cash balance is maintained. Sometimes they also speculate some unfavorable things to happen in future. So to meet those unfavorable things also, cash balance is maintained. So to avail benefits extended by suppliers and other stakeholders, to avail those benefits, then cash balance is maintained. So as and when these things are announced, utilize these cash balances to get the benefit out of that. Apart from that, if they foresee that there is some uh, uh, unfavorable things would happen, to meet such situation also, amount of cash balance is maintained. Okay. Then failure to carry sufficient cash levels can lead to loss of settlement discounts. They cannot avail that. Loss of suppliers' goodwill, poor industrial relations, and potential liquidation problems. So, if they fail in the short run, that can lead to a failure in the long run as well. So, just by not making the payments in the short run, does it result in? Yes, it is a vicious cycle there. If the payment is not made, the supplier will not come forward to extend credit. So material cannot be purchased on time, or all the funds are used only for purchase of material. Then lack of availability of material, or no supply of material, production gets affected. When production gets affected, definitely they will not be able to meet their customer demand. So that can result in a long term failure as well. So making the payment promptly to the suppliers and other stakeholders promptly will also ensure that their business runs smoothly in the long run. So, if the short run there is a failure, that can result in a long term failure also. Okay, so that can result in a potential liquidation problem. The liquidation problem is they are not able to make the payments to their creditors promptly. So, that is liquidation problem arising. So there should be a proper balancing act of, or we call it as trade-off. So maintaining the liquidity, maintaining some amount of cash balance, and also ensuring that they are not affected on their profitability part of it. So the investments into other assets also should continue, as well as also to see that whatever is the minimum requirement of cash, that is maintained, and they proceed further. So there is a balancing act, or we call it as trade-off, wherein both the aspects, the liquidity and the profitability, both these aspects are looked into. So for that reason, the first thing is there are cash forecasts taken up. Cash forecast. How do we understand what are cash forecasts? The first point of it is if a cash budget is prepared. So when a cash budget is prepared, cash budget has three different parts. The first part talks about if there is a cash budget prepared. So cash budget can be prepared as low as or as short as a period of 1 week. So in the current period, for the current period, maybe the next week, month, next quarter, or next year. So whatever is the time period for which a cash budget is prepared. So during that period, let's say for if the cash budget is prepared for 1 month. So during that 1 month, what are the sources from which they would receive cash is cash receipts is what is um, calculated. So because they have made sales to the customers, so customers would pay during this 30 days period. So some amount will can be expected from the customer. So they can collect the amount from customers. Some other sources, irregular sources also, that maybe something is sold off and they receive cash. But the major source of cash which is received is on account of sales. So sales may be made in the current period. So the current period sales, cash may be received. Maybe they made sales in the previous periods as credit sales. So those customers will pay during this month. So the amount can be collected or received from the customers. That's another source. Any other irregular source, like any assets are sold off or something, from that also cash can be received. But technically, first we need to understand what is the total amount of cash receipts, or the cash collections from various sources. So first, that is estimated. After estimating the cash receipts, the second part of it, the cash payments are also estimated. cash payments are estimated. So what are the reasons, or what are the things for which cash is needed? Cash payments are to be made to the supplier, the one who supplied the material on credit basis. The other stakeholders are like the landlord has to be paid, the employees have to be paid, then other operating expenses like um, all that which is needed in the factory administration, selling and distribution, travel expenses have to be made, printing, stationery, legal charges. There are so many things we come across. So all the cash payments have to be looked into. They have to be taken care of it. Noted that we should be careful not to include any non-cash expense. Sometimes we also have in the question certain details like depreciation was charged or amortization was there. So when we see such things, we should not include, because the point here is only cash payments. So from the cash receipts, the cash payments have to be deducted. So we are checking as to how much would be received and how much they will have to pay in the next period. If we are taking for 1 month, so in this 1 month period, what is received and what would be paid is what is assessed. After that, if let's say cash receipts are more than the cash payments, so that's called as surplus. Otherwise, if the cash payments are more than the cash receipts, we call it as deficit, which means that in this next 1 month they will not have sufficient cash to meet their payments. So once this is identified, if they have a surplus, there is no issue, they are comfortable, so they can meet all their payments on the due date and nothing gets affected. So they can carry on with the business in the long run as well without any problem. So they are safe if there is a surplus. But if there is a deficit, then it is indicating that they do not have sufficient amount of cash balance to meet all their payments. In that case, if there is a deficit, then they can make some short-term arrangements like an overdraft is raised. Yesterday in one question, when we were answering that question, we have looked into and then we saw that there was an overdraft arising. So measures will be made to raise some short-term loans or avail that overdraft facility what they have. Okay, some way they will prepare themselves to meet that deficit. Okay, so surplus they are comfortable. Too much of surplus is available also. Maybe a part of the surplus can be deposited in some um, uh, some way in which they can earn return. Some source they will deposit. Too much of surplus, or if there is a deficit, they make some arrangement so that the payments are made promptly. Payments, if they are not made promptly, business reputation is getting affected. So to ensure that the reputation is intact, they have to make the payments. To make the payments, they have to first understand whether they would have sufficient cash balance available with them. For that reason, first cash receipts are estimated, then cash payments are forecasted, then we compare receipts and payments and then understand whether there is a surplus or there is a deficit. Okay, so receipts and payments forecast is taken up, and then statement of financial position forecast. Yesterday's question is that that is one example wherein they're anticipating that sales would double. So when the sales double, what is the impact on the balance sheet when certain items are also would double along with the doubling of the sales. When the sales double, when what are the other items which would double is what is looked into, and then estimated about how much cash is available or what arrangements have to be made. So that problem of statement of financial position indicated that there would be a overdraft of 50. Yesterday we've done one problem. Okay, then along with that there are certain other working capital ratios also which have to be used and calculated. After a while, I'll make you work out one or two questions on how cash can be forecasted. So from the examination kit, we'll take up a question about how it is done, because it's already there on the slide. Let's work it out, and then after that, we'll go back to the examination kit. Did you work out any cash budget questions in the class? Are you aware of how a cash budget is prepared?
No, ma'am.
You've not done even one question. Okay. Okay. Um, Simple question. Did you finish the syllabus, or before finishing the syllabus, training is conducted for you? College did is the syllabus of FM completed, or before the syllabus got completed, you are attending the I mean, these classes are arranged.
Ma'am, our subject was completed 3 4 months ago,
Oh,
and we didn't did ACCA level syllabus.
okay, 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 okay. Fine. There is one question given here. Sales before discounts for a company are predicted to be as follows. So there are sales forecast predictions for the month of from the first month until the sixth month. 1, 2, 3, 4, 5, 6. So for 6 months, the sales amounts are given as 50,000, 55, 58, 63, 70, 74. Note down the points here. Let's see. It says that 20% of any month's sales are on cash basis. 20% of the sales will be for cash, with customers taking 2% discount. Then 40% of the sales will be in paid in the following month, will pay in the following month. Then 35% of that will be paid 2 months later. The remaining 5% will be written off as bad debts. So sales are 100%. If sales are denoted as 100%, once the sales are made, 20% of them are cash sales, 80% of them are credit sales. So 20% are cash sales, so they will be received immediately. Okay. These cash sales are made by offering a discount. Discount is 2%. So 20% of the customers, or 20% of the sale amount will be collected immediately, but the value will be 2% less. So only 98% of the cash sale value will be collected from the customers, because they're paying immediately, discount is given to them. Then the rest of 80%. So the rest of the 80%, this 20% is cash sales. The rest of the 80% is split again into, it is not that the balance of 80% will be paid in the next month. It says that the balance of 80%, out of uh, out of that 80%, 40%, so 40% of them will pay in the next month. So 40% of the credit sales will be collected in the next month. After that, so how much is remaining? 20 plus 40 is 60%. So the balance of it is another 40%. So what about the other 40%? Out of that 40%, it says that 35% will be received the following month. So 2 months later, it will be received. So 35% of that will be received in the following month. So following month would be 2 months, because this is the first month, the same month in which the sale was made. This is the next month. Okay. This is 2 months later. So same month, zero. If we put it as t is equal to 0, this is t is equal to first month. This t is equal to second month. So that's following month. After that, When we add them up, we see that it is only 95%. 20 plus 40 is 60, 60 plus 35 is 95%. So what about the 5%? So the 5% they are assuming it to be as bad debts. So 5% of them will be written off as bad debts. These are the credit terms which are given. So to understand what are the cash receipts, this is the structure which is given. 20% of the sales are made as cash sales, so immediately it will be received. But then that cash sales also is given with an adjustment saying that the customers are given a 2% discount. So first calculate what is 20% of sales amount, and of that only 98%, because 2% is discount, it will not be received. 98% will be collected from the customers. Done. After that, 40% of the current month sales will be received in the next month. Then 35% is 2 months later. So that is how we have to remember. We are asked to prepare a cash receipt statement, calculate the cash receipts for the months of 3 to 6, third month, fourth month, fifth month, and sixth month. So these are the 4 months for which we have to prepare. But we are focusing on how much cash is received during third month, during fourth month, during fifth month, during sixth month. Cash received. Okay. So for example, let's say if we are looking at January, if sales are made during January, so this will be received in January, this will be in February, this will be received in March. If we are preparing a statement of March, statement of cash receipts for the month of March, so third month is March, let's put it as this is as March. If we are talking about collection for the month of March collection can happen from January sales also. January, when the goods are sold, there is one part of it which is received in March. Similarly, if we are talking about this as February, 20% will come in February, 40% will come in March. So we see that a part of the sales are also made in the previous month, February. So when we understand the credit details explain us that the same month, the next month, the following month, 3 months period. Okay, that is how it will be collected. So how much is collected in any month, we'll have to go backwards. We have to go backwards and then look into that. Let's put it as this is as March. Let's take this one. So this March month's amount will come in the March. Okay. So the previous months. So if we are focusing on March, so the month of March amount, how much percentage? 20% of that will come in March. 20% into 98%. So that is there. The before month, which is February. February 20% in February, 40% in March. So February sales 40% will come in March. I hope I am clear. If it is not clear, please stop me and ask me. 40% of February sales will come into March, then 35% will go into April. So here we see that February sales, 35% will go here. Then before that month is January. So January, 20% in January, 40% in February, and 35% in March. 35% in March. So do you understand that? So we see that if it is collection, we have to look backwards. All the time we have to look backwards to see how they are collected. When which month sales are collected in that respective month. Am I clear? If this concept is clear, only we can solve this question. Anyone has a doubt, want me to explain once again also, I will do that. Please ask me. Unless and until we look backward, it is not possible for us to take up the calculation. Assuming you understood, I'm proceeding it further. Okay, so in your notebook also you write 5 columns: month, third month, fourth month, fifth month, sixth month. Is my voice coming properly or is it breaking in between? Is it fine?
Yes, ma'am.
Okay, because sometimes in between a message is popping up, your internet connection is not stable, so I'm little apprehensive about that. Okay, so because they are asking us to prepare it from the month of third month until the sixth month. So month 3, 4, 5, 6. So starting with the first month. So cash sales. Every month's cash sales are 20%. So 20% of each month's cash sales has to be calculated into, because they are given a 2% discount, into 98%. So the balance of it only will be collected. So we need to write 20% of the respective month sales into 98% is the cash sales part of it. So this one is about the cash sales. Okay. Did you write the figures? Did you calculate? I just waited that you would use your calculator and do the calculation. Did you calculate them?
Yes, ma'am, we are
Okay.
doing.
Okay. Okay. After the cash sales, the cash sales and the collection part of it is taken up. So let's start with the third month. So third month, we see that as much as it will start from the first month. So let's see, first month, start from the first month. So first month, 20% in the first month, then 40% in the second month, and 35% in the third month. So because third month is there in our purview of working out the cash collections, so we have to start from the first month. So first month, what percentage of it will come to the third month is what we have to see. So first month, 20% in the first month, then 40% in the second month, and 35% in the third month. So okay, it's presented in a different format. Okay. Let's see. Um, I will along with you work it out in Excel sheet. Just 1 second. Just bear with me for 1 second. I'll put it. Um, so it will go. If this is the logic, see each month. First month, that's the third month, 20% here, 40% here, 35% here. Um, okay. So quickly, third, fourth, fifth, and sixth months. Um, you have understood the cash sales part of it, and you also have worked it out. So I'm not showing the calculation here. I'm just copying the values as they are. Here it is 11.4 because you've already done that. I'm not repeating it. Then this is 12.3. Then here it is 13.7, and then here it is 14.5. Fine. The terms are 40% of sales will be paid in the following month. So I'm showing this same thing. How we work it out is what I'm showing here. So 1 month if it is taken, so 40%. See, the first month, third month sale is 58. So here it is 58 into 20% again into 98%. So that is how we got 11.4. So if 20% is paid in the third month, 40% will be paid in the fourth month. So take it as here, take the amount 58 into 40%. Okay. When will the 35% be paid? That will be paid in the fifth month. So here it will be is equal to 58 into 35%. Do you see that? 20% here, 40% here, 35% here. Similarly, take the fourth month. 20% here, fourth month sales are 63. So 63 into 20% into 98%. So we have this one. Then 63 into 40%. Okay. Then we have 63 into 35%. Right. Then the next month, um, here 70 is the sale, is equal to 70 into 20% into 98%. Okay. Then the next one, here we have 70 into 40%. Then after that, seventh month onwards, we do not have. So we finished third month in third month, fourth month, um, and fifth month. So maybe for your better understanding, I'll fill that with the color. So this is how cash is collected. Fourth month, a part of it is collected in the fourth month only. Then we see in the fifth month. Then we see in the sixth month. Then fifth month, a part of it is received in the fifth month. A part of it is received in the sixth month. Seventh month is also there, but because we are not calculating it for the seventh month, we are not looking at that. Then coming to the sixth month, a part of it is received in the sixth month. Done. But then we see there are gaps here. There are certain gaps. So if we are spreading into future, something from the past also will come forward here. If we are spreading into future, so the past sales in the first and the second month, with the sales which are made, also will come into the current months, that is third month and fourth month. So we need to look back into the previous month, second month, that is 55 sales. 55, a part of it will be in the second month. The next 40% will go to this one. 40% will come into March. Do you see that? So here February month sales are 55. 55 into zero point 0.4. Okay. Then out of 55, a part of it will come to fourth month, which is 35%. Did you understand that? We need to also look into the okay. Coming to 35, the first month 50 sales are there. So 20% in first month, 40% in the second month, 35% in the third month. So here we come here and we have it as 55 into 35%. I hope I made it clear.
Yes, ma'am.
That is how it has to be collected. This is not the only format in which we would be working out. It could be in any fashion. The way you understand, you just have to spread it across and then write that. Okay. Since I may colored it also accordingly, it is easier for you to later on also understand how we work out this solution. Okay. Let's get back to the so how much cash has to be maintained is the question what we are looking at. So the advantages we've looked into, if the cash is maintained, they can avail discount offers, they can meet their day-to-day transactions. Also some unforeseen thing or some contingencies which may arise in future also, by speculating that that they can uh, as a precautionary measure, they can maintain certain amount of balance, and too much of cash balance also not to be maintained, because it can get it can affect their profitability, that can get affected. So how much cash has to be maintained? There are two models which are covered in our syllabus. The first one is Bauman's cash management model. The second one is Miller ORR cash management model. Yesterday we've learned about EvoQ under inventory management system. The same is the logic here. Also we apply it under Baumol cash management model. So Baumol cash management model is given as a formula. Do you see the one looks similar to EvoQ model under root 2 COD by CH. So here it is CO is equal to this transaction cost. There it was ordering cost. Okay. Then demand for the cash, that is demand for the material there. Here it is cash of holding, cost of holding cash, that was cost of holding inventory per year per unit. It is the formula wise it is the same, the explanation wise also it's same. There it was inventory, here it is cash. Okay, that is a simple way to remember what is Baumol's cash management model. Okay. It is based on certain assumptions. First one, cash use is steady and predictable. Cash inflows are known and regular. Day-to-day cash needs are funded from current accounts. Buffer cash is held in short-term investments. After that, we need to learn the next model, which is there is one simple example. We'll work out this simple example and then go to Miller and ORR model. A profitable company. Please, there is an example here. Look into this one and then write down the solution in your notebook. Baumol model. A profitable company has a cash balance that is growing over time. Each month it generates 25,000 excess cash. It intends to transfer this cash into a short-term deposit account, which would earn 3% per annum. Every time it transfers money into the account, it incurs a transaction fee of $25. Using the Baumol cash model, calculate the optimum amount of cash to be transferred each time. So the formula is under root 2 CO. The variables are under root 2 COD by CH. So we have to identify these variables. What is CO, what is D, what is CH? That is what we have to identify. The terms are each time it generates $25,000 cash, excess cash. Okay, each month, so month wise. After that, it intends to transfer this cash into a short-term deposit account, which would earn a 3% per annum interest. Then every time it transfers money into the account, it incurs a transaction fee of $25. Right? CO is equal to $25. The requirement of cash requirement is 25,000 into 12. So D is equal to, what is D? D says the demand for cash over the period relates to cash needs for day-to-day transactions. So how much per month they have identified it to be as 25,000 to 25,000 into 12, 300,000. Then we have CH as 3% per annum. Take it as 3%. Substitute in the formula. And arrive at the value. Substitute in the formula, arrive at the value. We'll work out some more questions from the examination kit after a while. But today we'll learn the other model, Miller ORR model. So if you're done with that, we'll go to the our regular PPT. Okay, there's another model, cash management model, which is given as Miller ORR model. Okay, so what is this model? The Miller ORR model. Okay, I hope the figure looks little better. Okay, we have been discussing for some time that too much of cash should not be maintained because it gets affected, the profitability gets affected, it affects the profitability. And also we've looked into as too little also should not be maintained. Too little also should not be maintained, um, because it affects their liquidity position, the reputation gets affected. So in that context, there is one model which is given, called as the Miller ORR model. It says that at any given point of time, there is a minimum level of cash which is needed, the least amount of cash. So maybe from experience, they understand what is the minimum amount of cash which is required. So that, let's put it as minimum level. Then any given point of time, there is a maximum requirement of cash. Beyond that, uh, it would not be required. So in some way they also estimate that what can be the maximum requirement of cash. That's the maximum level. So there is a minimum level, there is a maximum level of cash which is required. Okay, cash is not always stable because there is cash going out because payments are made. Cash is also coming in from various sources. The main sources is like from customers. Cash is received. Cash also has to be used for making payments. So cash receipts, cash payments, this is an ongoing process. So we see that there are many fluctuations which keep happening. So this particular model says that, so if there are fluctuations, we see that there are fluctuations. Sorry, for a while I got disconnected. Okay, once again, let's start. See, we see that there is a minimum cash requirement, that is the minimum level. In any case, they would not. I mean, they would require as little as this much. That's the minimum level which is anticipated. How much cash is needed is, I mean, slow going business, very little. Many business with many activities, multiple transactions and all. The number of transactions are multiple, so more amount of cash balance has to be maintained. So whatever is the situation, it differs from business to business. So at any given point of time, what is the minimum amount of cash is needed by the business can be known, right? Similarly, for that business, what is the maximum amount of cash which would be needed also can be understood. So how much in worst scenario, what is the maximum requirement also can be known. So now, what is the minimum level, what is the maximum level after it is known? We see that cash is not always stable, it is not the same all the time. Cash balances keep varying because every single day there is a transaction which takes place. Maybe something is received from the customer, sales were made, so cash sales are received. So sometimes back sales were made, from credit sales, cash is received. Similarly, payments have to be made for so many transactions, for rent, for salaries, for wages, for other expenses. Something material has to be purchased, payment to suppliers is due. So we see that cash balance is not stable. It keeps fluctuating. So it keeps rising. So we see that there are fluctuations here which are rising. Okay. Then we also see that the cash balances are going low also. So touching the minimum level. If we see that the cash balance is quite fluctuating at any given point of time, the cash balance should come back to a point called as a return point. So that is what is mentioned. It should come back to a return point. When the minute it goes to the maximum limit or the upper limit, we see that it is ensured that it comes back to the return point. How does it come back? We will see that. So when the cash balances are rising, and at any given point of maximum limit, how much should be maintained is already understood. So if there is a situation which would be that the cash balance will exceed the maximum, it goes above that, to curtail that, to stop that, immediately a course of action is taken up, so that this cash balance which is rising, it falls down and comes to the return point. Similarly, if the cash balance is going down, it is not allowed to go below the minimum level, because at any given point of time, minimum amount of cash balance has to be maintained. If the requirement is below this one, so at this point, some course of action is taken up, so that it comes back to the it comes back to the return point. But what is that return point? So return point is given to us as, there is a value for the return point given to us as lower limit. So lower limit, it is known for each type of business what is the minimum or the lower limit. So the lower limit plus one third of spread. Okay, lower limit plus in bracket 1 by 3 of spread, and spread is again elaborated and it is explained by a formula. The spread value is 3 into 3/4 of transaction costs. For every transaction which is taken up, there is amount of transaction cost. Just now in Baumer's model, cash management model, we have looked into what is the transaction cost. So for every transaction, there is a transaction cost also incurred into the variance of cash flows. What is variance of cash flow? On an average, there is some amount of cash balance which would be maintained. Anything which is not according to the average cash balance is a variation in the cash balance, that is variance. So over a period of time, various values are looked into and the variance is calculated, something like standard deviation. I don't know whether you've done statistics by now. If you've done, you would understand the meaning of mean, average value, mean, the standard deviation, and variance. I don't know whether your curriculum by now you have finished it. Did you learn statistics?
Yes, ma'am.
So you understand variance. So what is the variation from the average value is the variance. Okay. Transaction cost 3 by 4 into transaction cost into variance of cash flows divided by interest rate whole to the power of 1 by 3. So there is a formula which is given to find out what is spread. After we find out what is spread, we come back to the return point. On an average, this is the amount of cash balance which has to be maintained. So how do we come to this one is by calculating lower limit into 1 by 3 into spread. So if that is the case, how do we come to this return point? By calculating spread. Spread is given by a formula. But how do they come back to the return point is, see, we see that when the cash flows are rising, so too much cash is available. So when too much cash is available, whatever is the surplus cash which exceeds beyond the maximum level, which is going in that direction of exceeding beyond the maximum level, so all that cash is accumulated and it is invested into some deposit. So immediately when such a thing takes place, they deposit and come until this point of return point. So excess cash which is available, cash in the form of cash has no returns. So that excess balance of cash, whatever is available, is immediately deposited and they bring down the cash balance to the return point. Okay. Similarly, when there are cash flows going in the reverse direction or downward direction, so if it goes below that, they will not be able to make their payments. So the payment part of it gets affected. So this is the minimum needed, but if the cash availability is below the minimum needed, then in that case they can take up actions like maybe a short term loan can be raised, or because they have already deposited, if they have these deposits available, what we call it as marketable securities or some other type of short term investments are available, they can sell those securities, or if they do not have those securities, they can raise some loan. Okay. And see that, ensure that from this minimum level it again comes back to the return point. By way of doing that, they are ensuring that they maintain an average cash balance. Okay. By way of a formula, what is this return point is given by way of these variables. The formula is given, we substitute these variables in the formula and understand what is the return point. So the logic says that when the cash balances are fluctuating, when they are rising, too much of rise in the cash balances also to curtail that, the cash of amounts which are available are deposited and immediately the cash balance is brought down to the return point. Maybe a deposit is taken up, the amounts are deposited. Usually we see that into marketable securities, so that whenever they require they can sell these securities again. Okay. Marketable securities. After that, if they see that the cash balances are also falling, they are going down to the minimum level and below the minimum level, to ensure that they again come back to the normal point, that is the return point. They may take up selling their marketable securities or converting their deposits into cash, some other types of current assets which are available, convert them into cash and see that the cash availability is there. If these things are not available, go in for um, raising some short-term funds so that they can meet the cash balance. I hope this is clear. I hope the model is clear, the Miller ORR model.
Ma'am,
Yeah.
shall we try one or two questions on this?
Ah, for every topic, I will make you work out questions for every single topic. Okay. My focus, I mean, the remaining time we will work it out. My focus is first, I will deliver the entire content, and the remaining time, because we have 15 days time to finish this training. So in this 15 days, today is the fifth day. So we may require another 5 days to finish the syllabus, 5 or less than 5 days. So we will still have another 5 days. So 5 into 2 20 hours, 5 into 2 10 hours of training will be available. So I will make you through. I will take you through the examination kit covering every single topic which we have done from the syllabus. Okay. Now also we are going to take up a few questions from cash management, um, inventory management from the examination kit. Short questions only we'll take up in today's class. Is this explanation clear? If the model is clear, then we can go.
Yes, ma'am.
So I'll put you through the exam kit and the questions in the exam kit, and then we'll take up the questions. Question number 68, 69. Now, in this time, 68, 69. Then we'll do 70 and 71 also. So let's work out these four questions in this time. Just let me prepare the. Okay, question number 71. Question number 71 says that a company has erratic daily cash movements with a standard deviation of 3,000 per day. It costs $25 to move cash between its current account and its short term deposit account. The deposit account earns an interest rate of 7.3% per annum. There are 365 days in a year. Calculate to the nearest thousands the spread between the upper and the lower limits that should be set for the current account using the Miller ORR cash management model. Okay, let's start writing this one. Let's put the formula first. Spread is equal to, write the formula, spread is equal to 3 into, in bracket, 3 by 4 into transaction cost into variance of cash flow. The entire thing divided by interest rate. Okay, so that fraction, the fraction whole to the power of 1 by 3. So there is one bracket for 3 by 4. So that is a fraction. This 3 by 4 is multiplied into transaction into variance cash flow. So then that will become the numerator. So this numerator divided by the interest rate, the entire fraction to the power of um, 1 by 3. We'll define what are the terms. Fine. Let's define the terms. Transaction cost. Transaction cost is equal to, how much is transaction cost? It costs, how much does it cost?
$25.
$25. Done. After that, we need to know what is the variance of cash flow. Variance of cash flow is equal to, so let's see how much is variance of cash flow. What is given? Standard deviation is given as 3000. What is the relationship between standard deviation and variance?
Variance is equal to square of standard deviation.
Variance is equal to square of standard deviation. I'm not able to find it. I'll just write it here. Deviation, standard deviation square. So how much is standard deviation? Standard deviation is given as 3000. So here it would be, what would be right? If it is given as 3000, so it will be taken as 3000 to the power of 2. That's variance of cash flow. What else do we need? We need to know what is the interest rate. Interest rate is equal to, it's given as 7.3%. Okay. In a year, there are 365 days. So, so interest rate per day. Substitute the values and then calculate what is spread. Spread is equal to into 3 by 4 into
Ma'am, in denominator we will take the regular 7.3 interest rate.
No. Transaction cost per day, no? Interest
Okay,
rate
ma'am.
per day.
Okay, ma'am. Ma'am, and what we will do for the after that you have put in in the upper value of 1 divided by 3.
To the power of 1 by 3.
Ma'am, where we will take on the numerator side.
Um, I didn't understand. On the
Ma'am, the in the formula you have written interest rate. After the interest rate, you have written that to the power of 1/3. So
to
we
the
will
power of
take
1 by
for the
3.
interest rate.
Not the interest rate. See, the square bracket is there. After the square bracket closes the to the power of. So the fraction, the entire
Okay, ma'am.
fraction, this is applicable.
Okay, ma'am.
Even in the so maybe here it is little bigger, so you can understand. The square bracket starts after 3 and ends after interest rate. So within that we see the divide. So the
Okay, ma'am.
in the numerator we have 3 by 4 transaction cost variance. Denominator we have interest rate. So after the square bracket
Yes, ma'am.
closes to the power of. Okay.
Okay,
Um,
thank you, ma'am.
okay. So here we are asked about what is the spread. Spread is calculated as 28,000 28,348.22. So calculate is calculated to the nearest thousand. So nearest thousands, the answer will become 28. After that, all zeros, because nearest thousand, no, 28. After that, all zeros. So 28,000. So this question, this short answer question has only the spread calculation. So essay questions, when we take up, we will see the full length question about other aspects also. For the moment, how do we calculate spread? This is one short answer which is given. So we've taken up this calculation. Spread is equal to this formula. We'll take up question number 72. How much? Only 14 minutes. Okay, any doubts? We'll work out the remaining questions in tomorrow's class. So is there any other doubt? Because this will take a lot of time. Um, anything else?
No, ma'am.
Okay. Is there any thing like attendance is maintained?
Yes, ma'am. We are keeping a record of that.
Okay.
Ashley, I give the attendance to the Ashley.
Okay. Fine. I'll end the class here and send the recording to you. We don't have a class tomorrow, Saturday. Sunday anyways are off for you. Then we'll meet again on Monday. So Monday we'll proceed further with the other topics. What we have, there's only one small topic remaining in working capital, financing of the working capital. Only one small topic which is remaining. After that, we will move to the next topic, macroeconomic policy. So I think I'm assuming it should end in maybe 4 or 5 days, the theoretical explanation about all the remaining topics. The rest of the time we'll completely utilize in working out the questions from the examination kit. Okay, fine. I'll end the class here. Good day.
Thank you, ma'am.
Thank you, ma'am.
Thank you, ma'am.